Before Islamic finance came into being about 30 years ago, only the very rich could really afford to purchase homes or realize their dreams. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension on the subject by attempting the questions in the workbook. In the next module, we will be touching upon some of the major norms of Islamic finance. The promotion of trade by Islam as a means to make profit and the prohibition of riba. The concept of time value of money, which is used while pricing the goods or the usufructs or benefits to get returns. The greater the risk, the higher the return. The higher the return, the more attractive the deposit product will be. Financial institutions thus develop financial products that factor both the returns and the risk appetite of the customer. Islamic finance, while following the basic parameters of conventional finance, has an added mandate of Sharia compliance. Sharia has laid down the rules for the economic life of people like Ilyas and Ahmed. The main difference between the conventional economic system and the Islamic economic system is that the Islamic economic system is based on Sharia principles. Islam aims to minimize the social differences and help Muslims live in peace and harmony. Let's take a look at the differences between conventional and Islamic financial systems. The Islamic economic system is based on Sharia principles. The Islamic economic system is concerned about the moral implications of the business for which the money is used. Islamic financial system is based on equity and risk sharing, whereas conventional banking system is interest-based, which tends to yield risk-free return. In the Islamic financial system, the relation of investors to the institution is mainly that of partners, whereas in conventional banking, it is that of a creditor and a debtor. The Holy Quran and the Sunnah are the primary sources of Sharia in Islamic finance. Quran is the book of divine guidance. It is the literal word of God, which gives direction to mankind. Sunnah means the way of the Prophet Muhammad, taken from the Hadith, books that narrate the practices and the utterances of the Prophet. The other sources of Sharia in Islamic finance are Ijma, Qiyas, and Ijtihad. Ijma is the consensus among Sharia scholars about specific issues that are not clear in the Holy Quran or the Sunnah. Qiyas is the use of deduction by analogy to provide an opinion on cases not referred to in the Holy Quran or the Sunnah. Ijtihad is the independent reasoning by Sharia scholars on cases not mentioned in the Holy Quran or Sunnah in the light of clear tenets of the Sharia. Some of the fundamental principles of Islamic economics are: zakat. The religious tax zakat is introduced to narrow the gap between the rich and the poor. The wealthy should give a percentage of their earnings to the needy. Sharing of resources. All material goods are the property of God. Human beings are just His trustees. It is unlawful to hoard food and other basic necessities. Everyone is required to behave responsibly and honestly and play a role in ensuring a just society. Extravagance. Muslims should be responsible in spending. Extravagance and wastage should be avoided. The true servant of Allah is neither extravagant nor stingy, but holds a just balance between those extremes. Islamic finance refers to the means by which financial institutions raise capital in accordance with Sharia. The types of investments and financing that are permissible under Sharia. The socio-economic rules laid down in the Quran and the Sunnah are the fundamental principles of Islamic banking. Prohibition of riba or interest. Prohibition of gharar or absolute uncertainty. Prohibition of wealth from immoral activities. Sharing of profit, risk and loss. Riba. The word riba literally means increase. All transactions must be free of riba, whether giving or receiving, whether dealing with Muslims or non-Muslims. The Quran warns that involvement in riba-based businesses is equivalent to waging war with Allah and His Prophet, peace be unto him. All benefits and incomes sought in contracts, not covered by corresponding risk and value addition by way of labor or expertise, are riba. Gharar. All transactions are based on real or tangible assets or papers representing these assets having definite value. Economic activities involving speculations having the effect of gambling, in which both parties are involved in direct conflict of interest, are ruled out. Wealth from immoral activities. Gains from morally or socially injurious activities like theft, gambling, and lotteries are prohibited. Dealing in liquor, pork, pornography, and other immoral services are haram. Ban on elements that are haram keep the Islamic financial products Sharia compliant. Sharing of profit, risk, and loss. Parties involved in a financial transaction have to share both risk and reward. Whoever is the owner of an asset has to bear the risk or loss relating to that asset. No pain, no gain. A person has a right to get profit only if he is ready to share the business risk. Profit sharing in Islamic law. Profit can only be made through trade or investment. Therefore, Islamic banking is based on the trading or hiring of assets. Gains made by the Islamic bank are shared between the investors or account holders and the bank in a pre-agreed ratio. The twin pillars of Islamic banking. The two profit-sharing arrangements under Islamic law are mudaraba and musharaka. They are the two forms of partnership businesses and are known as the twin pillars of Islamic banking. Mudaraba. Mudaraba refers to a form of business contract in which one person with surplus funds who wants to invest in the business brings capital, and another person who wants to do business but lacks funds puts in his personal effort. The proportionate share in profit is determined by mutual agreement. Loss, if any, has to be borne by the investor. Musharaka. Musharaka is another form of joint business in which two or more persons or institutions provide finance for a project. All partners have to work for the project. All partners are entitled to a share in the profit in a mutually agreed ratio, but loss, if any, has to be shared by all partners in the ratio of investment. If Ilyas or the bank sells a commodity on credit or enters into any other transactions with Ahmed, where the repayment of money by Ahmed is deferred to a later date, Ahmed has to pay the debt irrespective of profit or loss to him. This is a case of debt. Going by the Quranic prohibition of riba, no increment is permissible in loans and debts once created or agreed. The lenders have the right to get only the principal amount of debt. Let's take a look at some of the rules on debt. When a debt is exchanged for money, it must be at par. When a debt is exchanged for another debt, that too must be at par. When a debt is sold or transferred to a third party for money, it must be sold at par only and with recourse to the original debtor. Adequate precautions must be taken to ensure the absence of riba in the entire transaction. Ilyas was awarded a performance bonus of 1 million dirhams. He is given an option to take the bonus amount either now or 10 years later. Ilyas would certainly prefer to take the money now. 1 million dirhams now means that Ilyas can buy goods worth the amount now. 1 million dirhams after 10 years would mean that he has to wait 10 years before he may buy the items. 1 million dirhams now implies Ilyas would have the alternative of investing the amount for 10 years and earning a return on the same. From the Islamic point of view, if Ilyas loans 1 million dirhams and gets any return over it after 10 years, it is termed as an interest-based loan. This has led to a mistaken notion that riba prohibition implies zero time value of money. Assalamu alaikum. I'm Omar. Welcome to the world of Islamic banking. In the next few minutes, you will learn about financial intermediaries, who they are, and the role they play in an economy. But before that, I would like you to meet two of my friends. Suppose Ahmed needs yarn worth about 10,000 dirhams for his textile unit. He approaches an Islamic bank. The bank purchases yarn from the market for 10,000 dirhams and sells it to Ahmed for 11,000 dirhams payable after 1 year. This transaction is perfectly valid and acceptable in Sharia. Here, the bank has taken value for the time given for repayment. Allah has permitted trade and prohibited riba. A seller in a trade, whether on spot or deferred payment, is free to charge any price. The profit that accrues to him in the sale is legitimate. Normally, the spot price of a commodity may be lower than the deferred price. Such price differential is deemed to be the time value of money. Time value of money in a sale is acceptable in the Islamic framework. But time value of money is not permissible in the context of loans and debts. Suppose the bank sold yarn worth 10,000 dirhams to Ahmed for 11,000 dirhams on deferred payment. The debt receivable by the bank is 11,000 dirhams. The bank can get the time value at the time of pricing the yarn, and the price is settled once and for all. The bank cannot demand any further return on the debt even if the yarn price goes up in the market or Ahmed fails to pay on time. Ahmed may have an incentive to delay the repayment. Ahmed might become selfish and tend to default. Islam obliges Ahmed to fulfill his promise and pay on time. As the system cannot work if debtors do not pay on time, Sharia scholars have allowed imposition of penalty for non-payment. However, such amounts received as penalty would go to charity and will not be treated as an income in the Islamic bank's books of accounts. The Islamic economic system aims at social justice without inhibiting individual enterprise. Ilyas need not compromise on his religious principles while reaping in the benefits on his investment. The financial vehicles envisaged by the Islamic law will benefit the society as well as Ilyas himself. As yet in its infancy, Islamic finance is rapidly gaining recognition throughout the world. Its ethical foundation has drawn the interest of not just Muslims, but also many non-Muslims around the world as clients. While boldly striking a balance between the worlds of religion and finance, the field of Islamic finance is expected to evolve continually in the days to come. Let's recap what we have learned. The basic differences between a conventional banking system and an Islamic banking system. Islamic finance is based on mandatory compliance with the Sharia or Islamic law. The basic principles of Islamic banking, such as prohibition of riba, prohibition of gharar, prohibition of wealth acquired through morally or socially injurious activities, sharing of profit and loss or risk and reward between the partners or the parties, payment of zakat by every Muslim who owns wealth to those in need. This is Ilyas. Ilyas is the Director of Business Development with a construction major. So, why is Ilyas happy? Well, he has every reason to be. His hard work just paid off. His employer recently rewarded him with a hefty performance bonus of 1 million dirhams. The twin pillars of Islamic banking, Mudaraba and Musharaka, two forms of partnership business. The issues of loan and debt in relation to Sharia compliance. No increment is possible in both cases. The concept of riba-free transaction and how the concept is extended into Islamic banking. This is my other friend, Ahmed. Ahmed owns a wholesale garment trading business downtown. Ahmed recently won a multi-million dirham order to supply a large quantity of garments to a client in Saudi Arabia. But why does Ahmed look worried when he should be rejoicing? The fact is, he does not have enough stock with him to meet the order. He has to import garments from India. But for this, he is in need of 1 million dirhams. Unfortunately, he does not have that kind of money, and he has very little time left to meet the order. So, I have Ilyas who has a cash surplus of 1 million dirhams and Ahmed who is short by 1 million dirhams to meet his working capital needs. To help Ahmed tide over his financial difficulty, I borrow 1 million dirhams from Ilyas and invest it in Ahmed's business. That is, by channeling funds from Ilyas, who is a cash surplus unit, to Ahmed, who is a cash deficit unit, I played the role of a financial intermediary. In any economy, you will come across several cash surplus units and several cash deficit units. The challenge for these economies lies in mobilizing funds from the cash surplus units and channeling these funds to the cash deficit units. My role as a financial intermediary may have worked well for Ilyas and Ahmed. However, as an individual, it would be difficult for me to act as a financial intermediary to these thousands of cash surplus and cash deficit units. So if it is not going to be me, who else will manage this mobilization effort? Financial institutions. These are banks, non-banking finance companies, and stock brokerages. These organizations are responsible for mobilizing funds from the cash surplus units, or the savers, and channeling the funds to the cash deficit units, or the borrowers or the fund users. Financial institutions structure financial products that help mobilize funds from the cash surplus units. For example, Islamic banks have deposit products and mortgage companies sell Islamic investment certificates or sukuk. Before subscribing to any financial product, investors weigh two factors. Investors prefer to earn returns on their investment. How much return do I get from investing? How easily can I convert into cash? Investors fear the element of risk in their investment. Will I get sufficient return on my investment? Will I get a regular return? Can I cash out and exit easily?